You are losing thousands of dollars to the stock market not because of bad luck, but because of one fundamental misunderstanding. While most retail investors gamble like they are in a Las Vegas casino, the top 1% treat every single share as a business asset. I have analyzed 7 specific habits that bleed portfolios dry, and the final mistake is a trap so subtle even veteran traders fall into it daily. Is the one that destroys your long-term returns more than anything else. So sit back, grab a cup of water, and let's get into it. Think about the first time you opened a brokerage account. Maybe you heard a tip from a friend, or you saw a ticker symbol trending on a social media forum. That is the first trap, chasing fads. It is easy to get caught up in the excitement of a stock that is up 50% in a week. But data from a 2021 study by the National Bureau of Economic Research showed that retail investors who frequently trade based on news cycles underperform the market by an average of 3% per year. That might sound small, but over 30 years, that is the difference between a comfortable retirement and having to keep working well into your 70s. When you chase fads, you are buying high, hoping to sell higher, which is the exact opposite of what actually builds wealth. The second mistake is one I see constantly, failing to define your time horizon. If you are investing money you need for rent next month, you aren't investing, you are gambling. Markets are volatile in the short term. Between 1926 and 2023, the S&P 500 index has had annual returns that fluctuate wildly, but the rolling 20-year returns have always been positive. You need to know if you are playing the game for 5 years or 40 years. If you don't know your timeline, you will panic the moment your portfolio drops 10%. That brings us to the third mistake, trying to time the market. People think they can jump out before a crash and jump back in at the bottom. I remember a friend named David who pulled all his money out of the market in March of 2020 because he was terrified of the global uncertainty. He sat on the sidelines while the market roared back. By the time he felt comfortable getting back in, he had missed the best 2 weeks of recovery that decade. Missing just 10 of the best trading days over a 20-year period can cut your total returns in half. Stop trying to guess the bottom. Just show up and keep buying. If this is starting to click for you, hit the subscribe button. I drop deep dives like this every week, and the best part is coming up, so you will want to stay around for the rest of these points. Now, here is where it gets interesting. The fourth mistake is ignoring the power of fees. It sounds boring, but it is lethal. If you have $10,000 invested with a 2% expense ratio versus a 0.05% expense ratio, the difference over 30 years is staggering. You are literally losing tens of thousands of dollars to fund managers who are often underperforming the index they claim to be beating. Fees are the only guaranteed loss in your portfolio. Keep them low. The fifth mistake is failing to diversify. This isn't just about owning 10 different stocks in the tech sector. That is not diversification. If you own 10 tech companies and the tech sector crashes, your entire portfolio goes down with it. You need to own pieces of everything. Large companies, small companies, international markets, and bonds. A Vanguard study found that portfolios properly diversified across global asset classes have a significantly lower standard deviation, which is a fancy way of saying less gut-wrenching volatility than those concentrated in a single industry. Spread your risk. Don't put all your eggs in one basket. The sixth mistake is letting your emotions dictate your moves. Fear and greed are the two most powerful forces in finance. When your portfolio is down, your brain screams at you to sell to stop the pain. When it is up, you want to put more in to capture the gains. It is the classic mistake of selling low and buying high. You need a systematic approach. If you automate your contributions, meaning you invest a set amount on the same day every month, regardless of what the news says. You remove your emotions from the equation entirely. You effectively force yourself to buy more shares when prices are down and fewer when prices are up. It is the most powerful tool you have. Okay, remember how I said there was one more mistake that destroys returns more than anything else? Here it is, the failure to keep it simple. People think they need an elaborate strategy with options trading, short selling, and complex algorithms. They don't. The most successful investors in history, including Warren Buffett, have consistently advocated for simple, low-cost index funds. In 2008, Buffett entered a bet against a high-fee hedge fund manager. The hedge fund manager used complex strategies to try and beat the market. Buffett just bought a simple S&P 500 index fund. After 10 years, the index fund had crushed the hedge fund's performance by a massive margin. The complexity was a hindrance, not an advantage. When you make your strategy complicated, you create more opportunities to make mistakes. Complexity breeds errors. Simplicity breeds consistency. Let that sink in for a second. You don't need to be a genius to build wealth. You just need to be patient, stay disciplined, and ignore the noise. That one shift alone, sticking to a simple, boring, consistent plan, could save you from the pitfalls that claim almost every new investor who enters the market with the intent to get rich quick. Once you see it this way, you can't unsee it. So there you go. 7 mistakes that beginners make and the simple, effective ways to avoid them. By avoiding these traps, you are already ahead of the vast majority of people trying to manage their own money. If you got value from this, share it with someone you know who is just starting their financial journey. And make sure to hit that subscribe button so you don't miss the next video, where I am going to break down how to actually build your first portfolio from scratch. Thanks for sticking around to the end. Keep your head in the game, stay patient, and I will see you in the next one.